You gotta be flipping my flapjacks, folks. Holy smokes, this ain't no joke. So many of my companies have just reported some insane news just in the past 48 to 72 hours. I'm going to take you through all these different stocks. I mean, we've got to talk about so many different companies in this video, from Amazon to Tesla to even the chef. Even we're going to talk about the chef in this video, okay? I think we're going to speak about 5 or different of my stocks. News that came out, my perspectives on them, am I buying them, am I selling them, am I not making any moves in regards to them? Yeah, it's an action-packed video, all in regards to my stocks. If you own any stocks that are similar to mine, then this video is going to be relevant to you. If you don't, it might not be the most relevant video to you in this one, folks. But we got a lot of news to get over in this one, so I appreciate everybody joining me. Thank you, everybody that subscribed to the channel. I appreciate each and every one of you. Let's get straight into this, okay? Amazon is going to lay off another 9,000 more workers in addition to earlier cuts. Amazon will lay off 9,000 more employees in the coming weeks, CEO Andy Jassy said in a memo to staff on Monday. The cuts follow an earlier round of layoffs that began in November and extended into January, which affected about 18,000 employees now at this point in time. So nonetheless, Amazon's doing, in my opinion, their last big cut of employees here, okay? And this is what happens when companies are, let's call it, getting their employee forces right. You usually get 2 to 3 cuts from these different companies. You saw the exact same thing play out with Meta there. It's usually not just one cut. It's 2 to 3 cuts. And in my opinion, this is Amazon's last big cut here. Could they do a smaller cut later this year? It's a possibility of maybe 1,000 or 3,000 workers, but I'm not even so convinced of that. This is their last major cut, in my personal opinion. And that goes the same for kind of Meta and whatnot. Now, people are looking at this and they're wondering, this is a very curious situation, right? Because if you go back since November, right? Meta had big layoffs announced in November. Amazon had big layoffs announced in November, right? And then Meta had another round of layoffs announced. Amazon's had another round of layoffs announced. But look at this, okay? Look at the difference in stock price performance since November, when these companies announced their first major layoffs, right? Meta's up 120% over that same time. Amazon stock's up 8% over that same time. 120%, 8%. People are like, what gives here? Amazon's announcing massive layoffs. Meta's announcing massive layoffs. Shouldn't they be performing somewhat in tandem here, okay? This is so important for everybody watching this video right now to understand the point I'm about to make, okay? Because this is massive, okay? If you look at a company like Meta, for instance, Meta has been attracting what's called a value shareholder base for years now, meaning essentially these are folks that look at Meta as a cash flow machine. They don't care as much about revenue growth. They really care about stability of the business model, building that income's bigger and bigger over time, the margin's bigger and bigger, okay? And Meta's been attracting that shareholder base for years now, really since 2018. Prior to 2018, they attracted more of a growth investor base, but since 2018, they've really been attracting a value base, right? And even folks like myself that I look at Meta as a value play more than a growth play, right? And it's been trading at very cheap P ratios for years now at this point in time, okay? So when you see when you see the stock price move the way it is off of announced layoffs, value investors value that move, okay? On the flip side, Amazon stock has never attracted a value shareholder base. Amazon's shareholder base is built of all growth investors. If you buy Amazon stock, it's because you're viewing it as a growth stock, okay? And this is a huge problem when you see layoffs announced for a company like Amazon, because the way growth investors look at that is they look at that and they say, what, are we not going to grow anymore? Why are we cutting employees, right? They're focused on revenue growth. And when you cut 27,000 employees, let's say, for instance, that's not really a growth move. That's a profitability move. And growth investors don't value that as heavy, okay? They're thinking about profitability like 5-10 years from now. They're not thinking about it today. And so this is where you get this massive divergence in the stock basis, right? And in the stock prices, because one base loves a cut. That's a Meta shareholder base, which is value investors, and one base is scared, and that's growth investors. When growth investors see, oh, we're cutting a ton of our employees, that scares them. They say, oh my gosh, our growth day's done it now at this point, right? And so that's the important thing to understand when you see cuts like this and you see one stock performing insane and then the other stock doing absolutely nothing. It's difference in shareholder basis, folks. It's a very, very important point I just made there. Now, in regards to me personally, when it comes to Amazon stock, right? There's a public account. I'm up to almost 700 shares of Amazon stock, okay? And I've paid a lot of different prices for the stock. I've paid the worst price I bought Amazon for was $149. Ugh. The cheapest price I paid for Amazon stock so far is $82.80, okay? And so nonetheless, I don't think this is a year where I'm just going to continue to buy and buy and buy and buy Amazon stock. This is like, one of those, I think, rare opportunities of a year where you can just acquire the stock for very, very cheap, right? Compared to where the stock historically trades at. There's a lot of uncertainty around AWS, around the e-commerce business, growth rates, what's going on in the future, profitability, all those sorts of things. And so with a year of uncertainty like that, right, you get this kind of tremendous, in my opinion, buying opportunity, and that's why I view Amazon stock as a better buy this year than Meta stock. Last year it was all about Meta. I looked at that year as just acquire Meta shares, Meta, right? This year is Amazon, and so different stocks are going to bottom in different years, and they're going to perform differently. I wouldn't be surprised at all if Amazon tears it up in 2024 and has a very similar year that Meta's had over the past, let's call it 3 to 6 months in regards to Meta stock. Well, really 3 to 4 months in regards to Meta. There, okay. Next stock up here. Oatly stock made a big move up here today, 5%. The stock's up 15% plus just in the past 5 days. What's going on with Oatly? Well, big deal was just announced with McDonald's. Yes, you heard me right, McDonald's, okay? Oatly's partnering with McDonald's to bring Oatly Barista McCafe locations across Austria. Now, at this point in time, right? And you can read more about it here, but basically they're doing a partnership in Austria. It's a big deal, and the reason being is it's just Oatly getting their foot in the door on in a way with obviously McDonald's here. And that matters, right? Because if this deal's successful in Austria, they could expand it more throughout Europe in general, right? If it's more successful in Europe in general, there's a decent probability they could expand it into the United States and maybe even in China, worldwide. And so it's a big deal. Anytime you can get this, you can't get too excited about it. You can't say, well, just because they got this deal, they're going to get a worldwide deal with McDonald's. But I can tell you, Oatly's in a position now at this point in time to be in every major market that McDonald's participates in. And so it's exciting. I'm happy about it. Oatly's definitely, starting to get their stuff together. It was an awful year, 2022 for this company, but they're starting to get their stuff together, right? They're talking about 23 to 28% revenue growth this year, which is tremendous. But the margins, that's the big thing, right? Gross margins to improve sequentially through the year and reach the high 20s by the fourth quarter. That's tremendous. The company believes that this progress will enable full year fiscal 2024 to deliver positive adjusted EBITDA. Once again, can't get too excited about this stuff, but it is like trending in the right direction now at this point in time. And with the price of oats coming down so much, with the deals they've done recently to raise a ton of capital, obviously their facilities being run by folks that just focus on that. Oatly's trending in the right direction. Can't get too excited about any of these companies, right, that are the small caps, because they've let us down a lot over the past, let's call it 18 months, but that one at least is starting to trend in the right direction, okay? Foot Locker. So Foot Locker got hit here today, 5% plus downward move for this stock. It's a pretty good sized position for the dividend account, which is a $170,000 account roughly, right? And this is almost a $30,000 position in that particular portfolio. So what happened with Foot Locker? Well, for the fiscal fourth quarter, reported on Monday, 97 cents in earnings per share, crushed the 47-cent consensus estimate. Now, I don't know if Seeking Alpha had the right number here because this was on an adjusted basis. So I don't know if they were going off of GAAP versus non-GAAP. Seeking Alpha could have made a mistake there. I'm going to have to look more into that. Additionally, $2.33 billion in sales in the quarter came in comfortably above analyst expectations, bolstered by 4.2% comparable sales growth, which surprised against a street estimate of 6% decline. Our team delivered a great finish for the year with a strong fourth quarter results that capitalized on resilient holiday demand and compelling assortment and inventory position from our brand partners, said Mary Dillon. We are entering 2023 with a focus on resetting the business, simplifying our operations, and investing in core banners and capabilities to position the company for growth in 2024 and beyond. However, Dillon offered an outlook for not only 2023, but further into the future that fell short of expectations. For 2023, management expects sales to fall between 3.5% and 5.5%. I call that a recessionary type guide there. That's my opinion on it. That's a recessionary type guide. While comparable sales are slated to drop between 3.5% and 5.5% as well. Analysts had expected just over a 3% decline in both metrics. A gross margin forecast between 30.8% and 31% for the year ahead also came in below the 31.5% consensus, right? So miss on revenue guide, miss on margin guide here. And lastly, if you're going to have a miss on revenue guide and a miss on margin guide, you're going to have a miss on EPS guide. That's the bottom line. That's just simple mathematics, okay? And basically, EPS guidance is for 335 to 365, which obviously fell well short of the 408 consensus out there. For the years 2024 through 2026, management expects total sales growth of 5 to 6%, with comparable sales, and that's per year, with comparable sales growth of 3 to 4%. Adjusted EPS growth in the low to mid 20s are expected in that time frame. Now, folks, that I can tell you is exciting. Foot Locker, value stock. Plain and simple. It's a dividend value stock, right? Plain and simple. Usually PE is trading around 10-ish, right? Very cheap stock. If you're wondering with that disappointing guide for 2023, wasn't that stock down more than 5% today? The reason that stock wasn't down more than 5% is the stock already trades incredibly cheap, right? It wasn't like this was some high flyer going into those earnings. And so nonetheless, I look at Foot Locker. It is a position I want to continue to add here. Now we're going to take this a step deeper because there's some other interesting things that happen here, but just my general opinion on this is I still have full belief in this company. 2023, not an exciting year. Obviously, I think that's going to be said for most companies out there in regards to this year, right? Many, many companies. And honestly, maybe they're sandbagging a little bit. With all the uncertainty out there, you got bank runs going on, you got all this uncertainty, you got the recession talk. Why not come in and just, throw down low numbers? You have all the right in the world. In this environment right now, you have all the right in the world to come in with low expectations, right? And then if this year just shapes up a little better than expected, then boom, you come in and you look like a hero because you're beating numbers quarter after quarter after quarter after quarter. So I believe what Foot Locker is doing here, I think you're going to see a lot of companies do this over this next quarter, where they're just kind of giving some lowball numbers and kind of seeing where things fall in regards to that, right? Foot Locker's to close 400 mall stores as it shifts to niche shops. In my opinion, in regards to this, I think this is one of those things like, if you think about mall traffic over the next 5 years, right? Some malls are going to do really well, right? And some malls are just going to continue to fall off and do worse and worse over this next 5 years, right? And so it makes sense that Foot Locker is going to close some of those mall stores and go ahead and redeploy those assets in other places. That makes sense there. But there's something more interesting here, and it starts here, okay? Foot Locker touts renewed Nike relationship. Okay, look at this here, folks, okay? Foot Locker CEO Mary Dillon touted a renewed and revitalized relationship with Nike, including an emphasis on sneaker culture. Okay, this is intriguing. Nike had moved away from its wholesale relationships so it could build out its direct-to-consumer channels, but ended up with a glutton inventory, right? Now, you know what I thought when I read that? First off, I thought that was great news. When I heard Nike was going to try to move away from Foot Locker, immediately I knew that was going to be bad. And I knew it was going to be bad for both companies. It hurt both. I'm like, this is so, I don't want to say stupid. That's just sounds, not politically correct. It was such a bad decision. I'll put it like that. Such a poor decision. I remember, I don't know if that was 2 years ago I heard about that or whatever. And as somebody that's a Foot Locker owner of their stock, right? Or if it was a year ago, 2 years ago. Obviously, I wasn't happy with it from the Foot Locker side because Nike is such an important customer of theirs. It's the most important customer, right? But I looked at it from even Nike's perspective. I was like, that's a bad move. Like, they need to be partnering with Foot Locker as much as possible. Like, Foot Locker does a great job of branding in their stores, of highlighting products, of doing a great job of merchandising. I was like, that is such a bad decision from Nike. And what this tells me Nike is not in a great place right now, okay? Because at the end of the day, if everything was going great for Nike, right? Why would they be interested in renewing their relationship more with Foot Locker now at this point in time? Think about that for a moment, right? If everything was amazing for Nike, they would have been like, we don't care, well, this is the right decision. But when you start backtracking, and then you in a matter of a year or two, you go from we don't want to work with you as much to all of a sudden, no, actually, let's get back together. that likely means something's going wrong, right? It's like in a relationship. Let's picture, a boyfriend breaks up with a girlfriend or vice versa, right? And then they come running back to that person a few months later or a year later. It's likely because they didn't find somebody better than you. Let's just call it what it is, right? And that feels like this in this Nike situation here. And so, I don't know, I'm not going to obviously place any short-term moves on this, but I do have to think, I wonder if bad earnings are coming for Nike or a bad guide is coming or something like that. Because like I said, for them to all of a sudden be like, oh yeah, let's build our relationship further now, Foot Locker, that's a big change there. So yeah, I don't know. We'll see what happens here. But between Foot Locker's guide, between Foot Locker saying they got a renewed relationship here with Nike moving forward, and kind of putting all those pieces together, right? I do have to wonder if Nike has bad earnings coming or guidance coming. We'll know within 24 hours from now because they report earnings within the next 24 hours, and we'll find out. We'll find out, folks. That should be interesting, right? Now on to the chef at this point in time. Some huge news announced from the chef. Now, the chef had been real quiet. It'd been real quiet for a while. And in regards to this one financially, I've already been hurt so much, the stock's $1. It's like it doesn't make a big difference. But I was kind of looking at it and how quiet they were, and I was thinking, there's one of two things. They're just really busy trying to make this company work, or they're busy trying to make a deal to be bought out or to get an investment from somebody or something like that, okay? And it looks more like they're on the lines of, just putting in that work here, okay? So in November 2022, the company announced a series of initiatives designed to achieve annual cost savings of approximately $30 million, which it believed could result in positive adjusted EBITDA and cash flow or by or around mid-year 2024. However, based on progress to date, the company now believes that it could achieve annual cost savings of up to $40 million or more in 2023, which, if achieved, would allow it to reach break-even adjusted EBITDA and become cash flow neutral during Q4 of 2023. Okay, that's surprising. I'll say that. That's very surprising. Approximately 6 months ahead of its original outlook. The anticipated cost savings include reductions in marketing, promotional expenses, workforce reductions, cost savings derived from operational efficiencies, new product introductions, and retail expansion. So, very rare, good news in regards to the chef, in regards to kind of their cash flow situation, EBITDA situation here, okay? Now, in terms of taking this a little bit deeper, in terms of getting into some of the nitty-gritty here, they're doing a reduction in 2023 marketing expenses of approximately $15 million, right? And, I don't know how much their marketing was really helping them. I'll just be completely honest. We haven't really seen it in the numbers, so honestly, if your marketing's not working, then you're just basically throwing money away. That's the best way to put it, right? Operational and automation derived savings of approximately $6 million, primarily driven by a reduction in labor and increased productivity in the same footprint. Savings of approximately $2 million associated with operating dedicated in-house cold storage facilities. They've been talking about that for a while. And a reduction in promotional programs contra revenue that are estimated to produce approximately $7 million in cost savings. In addition to the above referenced actions, the company has undertaken a workforce reduction plan, realigned company resources, and is on the progress of rationalizing its product portfolio, all while taking steps aimed at driving higher revenue in 2023. That's fighting for survival type stuff right there. You got to do what you got to do, right? With respect to ongoing operating activities for the company, they recorded its largest ever information resources total U.S. multi-outlook for the 4-week period ended January 29, 2023, as measured in syndicated sales of Tattooed Chef branded products. Tattooed Chef products are now in more than 24,000 stores across the United States, and the number is expected to increase for the 3 months ending March 31st. So great. We know in terms of the product getting into stores, it hasn't been an issue. We know volumes have been strong for the company, right? That hasn't really been an issue. They've got a million other issues that have nothing to do with that, right? They reached an agreement with CVS Pharmacy, under which Tattooed Chef branded entree bowls are launching at approximately 6,000 CVS stores during the first quarter of 2023. Cool. CVS doesn't move big product in terms of these sorts of products, but, it's good. It's, another place to be, right? Continued its previously announced Tattooed Chef branded expansion in Walmart stores, with early results indicating greater than 50% sales growth year to date in Q1 2023 as compared with the same period 1 year ago. Okay. Broaden its shelf presence for entrees, meals, breakfast, foods at existing retail locations, including Albertsons, now representing approximately 40,000 total points of distribution. Expanded outside of the freezer aisle with the launch of new refrigerated oat butter bars during Q1 2023, with initial exposure at Tier 1 regional retailer and several other regional retailers. Okay. Secured initial shelf space for the grain-free tortilla chips, which is a new line for them, with an existing Tier 1 national retail customer beginning in Q2 2023. All right. So nonetheless, I mean, that's exciting, but this is all like the chef has been executing phenomenal. Like if I was to give them a grade in terms of like their distribution into retailers, it's been an A+. Like I've never seen actually a company execute this well in terms of getting into different retailers, like the biggest of the big retailers. I've never seen it. And, I've owned a lot of really good companies, but I've never seen a company this good with this part of their business. But in terms of cash flow, in terms of burning money, they get an F grade for that, right? And so that's where you kind of got the divergence of Tattooed Chef. It's like, it's the best I've ever seen in terms of getting into stores. It's probably the worst I've ever seen with burning money, or certainly up there, right? What does Sam Galletti have to say, the president and CEO? He says, we continue to execute a plan that we believe will reduce cash burn, reduce annual losses, and strengthen our brand profile and retail presence. Tattooed Chef holds a distinct position in our industry as a vertically integrated, value-added, plant-based food company, and we remain focused on producing the highest quality products, pursuing innovation, and optimizing both the efficiency and utilization of our operations to unlock their inherent profitability. Although we still have much work ahead of us, we are seeing early indications of our progress on a sequential quarterly basis, with material improvements expected to manifest beginning in Q1 of 2023 and continuing throughout the year. Okay, that's exciting. Mr. Galletti noted that on a consecutive quarterly basis, comparing Q3 2022 to an estimated Q4 2022 metrics, the company reduced promotional spend by approximately $2 million, operating expenses by approximately $12 million, which includes approximately $7 million in selling, general, and administrative, approximately $5 million in sales and marketing. All right. Mr. Galletti concluded, the challenges that we are confronting are significant, but so are the opportunities. As Tattooed Chef's largest shareholder, I am personally invested in our long-term success, right? And, that's the thing in regards to this, right? Galletti, he's obviously the biggest shareholder, out there, right? And so if this company does go under, right, and they don't make it, obviously he's going to be hurt in a pretty epic way. This is his kind of golden goose, right? And he's even loaned the company more money recently. So, I mean, if this company wasn't to make it, it would be disaster. And so, my view on him in relation to this is I think he's going to do everything in his power to get this company through to hopefully make it to the other side of profitability and cash flow positive, right? As the biggest shareholder, like I said, if this company goes under, he's so screwed. And so there's so many different avenues that can go here. The debt markets are really tough right now. Obviously, in terms of diluting shareholder value, that's a really tough proposition because the stock's so low right now, right? So those are two tough avenues. I think if I was him, what I would be personally doing is I would be trying to reach out to other food companies and trying to get them to make an investment to get shares or maybe potentially options of the stock in the future and have those be a considerable shareholder, right? If that doesn't quite work, I would be trying to sell the company. And I know it'd be for a really low dollar amount, like $2 a share, $3 a share, but that's better than going BK, right? And so those would be kind of the avenues I would be looking at if I was him. If, let's say diluting shareholder value doesn't really make a lot of sense, or if it's really hard to get, a $20 million, $40 million loan from the bank or something to kind of get through to the other side. So that's what I would be looking at if I was him. That would be the ideal situation, is somebody that's looking for exposure in the plant-based food space to invest in this company, get a considerable amount of future shares, options, something like that. I've seen it happen before with companies, and especially in the food and drink space. I've seen it several times, right? And so we'll see what happens there, but that's kind of what I would be pursuing if I was him, right? You could also be doing some other interesting tactics around potentially selling off some of their assets, property, plant, and equipment to other companies that just focus on that, similar to kind of what Oatly did. Oatly kind of paved the way in terms of this, right? Oatly sold some facilities, raised a bunch of money from that essentially, and now they have another company that probably will probably operate those facilities on a better margin basis than Oatly could have, just to be quite frank. And so that's another possibility. So, Tattoo Chef has a lot of outs here, but it's still an ugly situation, right? On the financial front, the company expects cash at the end of December 31st, 2022 of approximately $6 million. That's like nothing, right? The company continues to require additional debt or equity capital and is pursuing multiple paths of an opportunity to raise such capital as soon as practical, right? So we'll see what happens here. It's obviously, it's a dangerous situation, right? It's a dangerous situation. I mean, if they can just make it through the other side, then we can, talk about the long term, right? But this year is just that year of like, it's a make or break year for the company. They're either going under or this baby's going to make it, and we've got a good opportunity to make some actual real money long term. But it's tough sledding for the company. And my hope for the company is that they make it, right? Not just from the financial front of like, potentially, hopefully someday getting back to break even, or even if that doesn't happen, just getting, to make some money back in regards to stock, right? And not just from like a pride standpoint, but if I just think about like the plant-based food movement, which I've been a huge fan of, and I think the plant-based food movement would be tremendously helpful. And I even talked about this in yesterday's video, right? And I talked about obesity rates and the amount of percentage of the population that is, obviously overweight. We're all talking about almost 70% of the United States population is overweight or obese now at this point in time, right? We need to change the food system in an epic way, right? And I look at all these companies that are very important, right? I think Impossible Foods is a very important company. I think Oatly is a very important company. I think Tattoo Chef's an incredibly important company. And, to see any of these companies go under that, in my opinion, are very important to this movement, it would be a huge letdown for the entire plant-based food space. It'd be a huge letdown to that entire movement. And I would hate to see it. Like I said, not just from the financial front, but literally from the front of making this happen. Because in order to combat the Coca-Colas, the Pepsis, the Frito-Lays and all the snack companies and all the other companies that are in this different space that sell, products that just aren't healthy for folks, right? In order to combat that, you need other big companies to grow that hopefully can get us on the right path. And if you don't have those companies, then those old school companies that got us into this place of 70% of the United States population overweight or obese, right? Those are going to continue to dominate. And in terms of those metrics of how many people are obese or overweight, it's just going to continue to get worse. That's a trend we've seen for decades and decades and decades. So we need a massive change in movement here, but it's not going to happen without big corporations that are part of that movement. And the old school guys, they're happy with this. They're happy that 70% of the population is overweight or obese. They're happy with how everything's been going. They've been making bank off that. And so, it's unfortunate, and that's just another huge reason why I hope this company makes it, man. I really, really do. Because it would be a huge loss to the whole movement that's been going on there, man. A huge loss, okay? So, next up here, Honest. So, obviously, Honest, they reported the last quarter of Nick Vlahos, the CEO, right? I was really, to be quite frank, I was pissed. That man got a golden parachute. He missed so many quarterly numbers. He, obviously the stock from the time it went public, $16 to the time he left, $1, $2 stock, just so depressing, right? And then he leaves with just silly money, right? To get fired. So, but anyways, I'm happy with kind of what Carla's doing, and she even posted this on her Instagram, right? Class in session for a post-earnings brief, got the, all the team members there, and, everybody needs to be part of this mission of Honest to get them to profitability as soon as possible, cash flow positive as soon as possible, and get this business into a healthy place, similar to what happened with Elf years ago with my Elf investment. So, I have a lot of faith in Carla. I can't get too excited about any of these folks, right? But I do have a lot of faith in Carla, coming from General Mills, coming from being a vice president of Amazon, that she'll get this company on the right track. But man, I was just so mad, seeing the numbers that Nick Vlahos got on the way out the door. Is it not small numbers, man? Substantial. And it's just like, it's like if we get fired, we get nothing from our job, right? And then you got, some of these folks that get fired and get millions and millions of dollars to get fired. It's like you do a bad job and you get that money. It's a very frustrating ordeal, right? Moody's. So Moody's has officially upgraded Tesla to an investment rating for the first time ever. Tesla now has a Baa3. Okay, interesting, okay? So here we are. Moody's, which graded SVB Bank, right, that just went under, they graded them with an A rating, and now we get Tesla for a B rating. I'm like, how the heck are they doing their ratings? It makes no sense, right? Tesla's an A-rated company, in my personal opinion, now at this point in time. It used to be a B or even a C or even a D-rated company in terms of balance sheet. Company now has $22+ billion of cash and cash equivalents. Solidly profitable company now at this point in time, right? They have, what, debts of $1.5 billion or so? They have stockholder equity of $44 billion. And I'm just like, Moody's, what are you doing, man? I don't think the Moody's knows what an A grade or a B grade and a C grade is. I'll just be completely honest. And they get proven wrong time and time again. And it's laughable to me. I'm like, if they should throw some sort of A grade in front of Tesla. You don't have to throw the highest A grade. But damn it, to put this one in the B category is a huge mistake in my opinion. That's just absolutely ridiculous, folks. No. You've got to continue to work with a sense of urgency in this market, folks. You have to work with a sense of urgency in this market. I'm telling you, 2022, with all the crazy inflation that we've seen, the highest inflation rates in decades, right? You got bank runs that have happened recently, all the scares in the financial system. You've got to work with urgency in this market. You've got to know what you're doing. You've got to take advantage of opportunities in this sort of market, because I can tell you, sky-high inflation is coming to an end. In terms of Fed working aggressively against the market, we're coming to about the end of those days as well, okay? In terms of bank runs, the financial system, collapse, all this stuff, that's about coming to an end as well. And so you've got to take advantage of this next, in my opinion, 6 to 12 months in front of you here and take advantage of a lot of opportunities in the market. And if you don't really know what you're doing, now's the time to get knowing what you're doing. Let's put it that way, folks. And so if you're looking to apply for my private stock group, the private wealth group, learn directly from me, everything I know up here about valuing companies, financial statements, all this stuff, check out the pinned comment down there. That will be for an application. You can get on the phone with O-Man, talk with him, see if it's a good fit for you or not. Maybe it's not. Or maybe it is, and maybe it's time for you to start scaling and taking this stuff serious, because, yeah, I can tell you it's not going to be like this forever, folks. And, the people that don't take advantage of these sorts of time periods always look back with regret. Appreciate y'all. Much love as always. Thanks for being subscribed, and have a great day.